So we just heard the chair of International Accounting Standards Board recognizing, a number of issues, but also showing some of the difficulties ISB is facing. So the meaning and the sense of or the purpose, if you prefer, of this session is to see from the other side of the other side of the sky, what is the situation from your perspective, from more sustainability perspective, even though I must declare that all the three eminent speakers are also very knowledgeable in financial accounting, so nothing completely new. So I think we agreed that Patrick was the first one to express some views from the EFRAG perspective. Patrick, we know, is the chair of Sustainability Reporting Board of EFRAG. Patrick, thank you very much for being with us. The floor is yours.
Thank you very much. Just for clarification, how many minutes do you give me? Because I don't want to expand too much.
Shall we say 10 in the second round?
Yeah, that's wonderful. Thank you very much. Okay, so in relation to the key topic that you are discussing today, and I listened carefully to what Andreas was saying and also what was said in the previous panel, I would say a number of things. Point one, of course, we are at a milestone moment in the EU with the, I would say, the finalization of the legal framework for sustainability reporting very recently, because as you all know, the end of the scrutiny period was end of October, and therefore since then we have in the European legal framework a sustainability reporting regime along the lines of the CSRD principles and provisions, and also along the line of the ESRS that have been adopted at the end of October. So this is a major step and not a minor achievement, so I just wanted to highlight that because it is the outcome of a long process, bearing in mind that it started in January 2020 with the key statement made by Executive Vice President Dombrovskis when he said, we have to modify the sustainability reporting today, which was then called non-financial reporting, in order to introduce, a mandatory regime based on robust standards. So I would say now we are ready to go, and companies are, of course, confronted with the challenges of implementing this relatively ambitious set of disclosures which are required following a key materiality assessment in most cases. Point one. Point two, we made every effort to capitalize upon, to build on, and to contribute to, the global progress of sustainability reporting. And we did that with GRI, and Eelco will certainly say a few words. And we just published yesterday, or made publicly accessible, that's the terminology we use, the interoperability index that we have drafted jointly with GRI, between the GRI standards and the ESRS, which highlights a high level of commonality, and also which will allow ESRS reporters to be deemed reporting with reference to GRI. So in order to avoid fragmentation. A similar approach is followed with the ISSB. We are working hard to finalize an interoperability mapping, since we are convinced that having worked with the ISSB for many I would say, almost years now, certainly in the last few months intensively. We are very close to finalizing a mapping of our respective disclosures, and the overall feeling is that an ESRS reporter or the ESRS standards embed to almost to a very large extent and almost a complete extent the ISSB disclosures. So in order to avoid, again, fragmentation and avoiding multiple reports. Point three, which I wanted to mention quickly, is that, of course, we are moving to the implementation phase, and it is for us extremely important to support implementation to the maximum extent possible. And that's why, by the way, we have approved at EFRAG yesterday an MOU with the GRI in particular, in order to stimulate capacity building, but also other objectives, but capacity building is important. On EFRAG side, we are developing implementation guidance, and we have also opened a Q&A platform at the end of October, where we try to address the questions that can be asked by all stakeholders if they so wish, of course, under a certain format, but we already received 140 questions, so it's not a minor task for us, but it's okay, because we want to be available to stakeholders at a moment that is not necessarily easy for when you start implementing. We are also developing the SME standards, and on Wednesday we approved the voluntary SME standard, because we want to include SMEs into the sustainability reporting momentum. The listed SME will be, I hope, approved before Christmas in the upcoming meeting of the SRB. It's already approved by the TEG. So listed SMEs, of course, is a much smaller population, but the voluntary SME standard is applying to the more than 20 million companies in the EU, that if they are not embarking upon a journey regarding sustainability, might be excluded from relationships. Or first of all, they might, ignore sustainability risks, opportunities, impacts in their decision making, and that would not be a good idea, even under a simplified format. And also, they would be excluded from relationships with banks and other companies, be they small or large, value chain. So for us, this is a major point. Digital taxonomy is also about to be finalized. The SME standards and the digital taxonomy will be consulted upon at the beginning of 2024. And we are, of course, on a journey to develop sector-specific standards under a revised timetable, because the initial timetable was not realistic. And the Commission has proposed to postpone by 2 years the delivery of the first batch of sector-specific standards. Last but not least, intangibles. Of course, as you know, we had many discussions with WICI at the time of the preparatory work conducted by the task force. The situation is at one the same time potentially positive, pros and cons, positive and negative aspects. The positive is that I think that, as it was illustrated early on in the panel, developing CSRD disclosures and ESRS disclosures is certainly contributing to giving more to casting more light on a number of tangible factors, because when you disclose about a risk or an opportunity, but when you address them properly, you create intangible. So, you know, this is, of course, this is a very broad and generic statement, but I sincerely believe that there is a room here for, you know, improving disclosures on intangibles. Of course, I share the view expressed by Andreas that, you know, changing the financial reporting to address intangibles is not the way forward. I think that sustainability reporting is a way to approach intangibles, but at the moment, it's only via indirect effects, if I may say so. So yes, that's the quote-unquote negative element. There is more to be done. And of course, there are ways to develop additional information within the sustainability report, potentially, but also in the management report or other documents, as the case may be. So that's what I wanted to highlight, Stefano, and happy to contribute following what my colleagues will have to say. Thank you.
Thank you, Patrick. Very comprehensive review of the big effort EFRAG is doing. And of course, the final note on intangibles, it's interesting because you see this additional information to be developed more likely in the management report or in the sustainability report, which of course an interesting, important viewpoint. I think the second one was Richard, and for, you know, whatever, if you is okay. Richard from WICI that has been taken into, it's been called upon at least 3 or 4 times, and your name already resonated. So what is your perspective from WICI, and also you're a distinguished academic that wrote about intangibles, incidentally, in your previous life. So Richard, the floor is yours. Thank you.
Thank you, Stefano. So what I thought I might do is reflect on some of the very interesting discussion so far as a starting point, and then comment on ISSB as an international standard setter and its relationship, how it works alongside GRI and ESRS in this space. So first of all, on reflecting, sort of framing the issues, I've got three points here. They all happen to begin with the letter C, which is rather nice. So there's an issue of conflation, and one of confusion, and one of clarity. The issue of conflation is conflating intangibles and sustainability. So we're sort of using those two things interchangeably. They're by no means the same thing. And depending upon what lens you have, they either are very closely related or they're entirely different from one another. So if you take the sustainability in you know, ISSB and CSRD to mean the sustainability of corporate performance and of value creation, then clearly intangibles are core and central to that story. If you take sustainability from a UN Brundtland definition or something similar, then sustainability is concerned with doing no harm. It's concerned with avoiding depletion of natural resources and so on, and that feels very far away from intangibles. So it's important to be clear about what we're actually talking about, is the first point. Second point on confusion is whether intangibles belong in the financial statements or not. The references to Barak Lev's book and the sort of presumption that because intangibles are not on the balance sheet, financial accounting is broken, I think is deeply flawed, and various references have been made to that already. My own work in this space, Stefano, which you mentioned, I have a couple of papers with Stephen Penman and one of them with Alan Teixeira and Andrew Leonard, which explicitly takes issue with the Lev argument. The fact that something is economically important doesn't mean it should be recognized on a balance sheet. So it's by no means obvious that this is a financial statement. So it's not obvious it's a sustainability topic. It's also not obvious it's a financial statement topic, and therefore not obvious that it's an IASB issue from a narrow financial statement perspective. However, the third question, on which there is clarity, I think, and a lot of commonality in the room, various people express this in one way or another, is this a financial reporting issue? Yes, unambiguously. So is this something that should form part of corporate reporting, and is corporate reporting deficient, and does it need fixing? Absolutely. Now, that then raises the question, given the earlier comments, is this an IASB issue? Is this an ISSB issue? Not clear which of the two. It's certainly an IFRS issue. But then it also certainly overlaps with ESRS and GRI, because it's not just a financial statements issue, right? So hence we're all in the room. So then coming to international standards and GRI, ESRS, and ISSB. We're currently in a state of evolution, I would say, in a very the world is changing very quickly, right? So on the investor-oriented corporate reporting, sustainability reporting front, there's been enormous consolidation, integrated reporting and SASB and TCFD and so on. And in effect, we're left with three significant standard-setting bodies globally, which are these three. And we currently have GRI very widely used, ESRS about to become mandatory in a very significant and very important way, really pushing the boundaries of corporate reporting. And an ISSB starting to be adopted and using quite a different approach from ESRS. So we're in this stage of experimentation, which I think actually is really healthy to have different ways of thinking about, and almost competing ways of thinking about how this space should evolve, given that it's by no means obvious how it should evolve. That said, of course, interoperability in and of itself is to be avoided at all costs. So the more time we spend having standards for the same thing and addressing interoperability between standards for the same thing, but the more time we're not spending developing good solutions. So we're kind of on our way, hopefully towards a world where interoperability is less important, but we've learned a lot more about what good reporting looks like in this space. Now, in that regard, a critical difference between, and again, something which hasn't really surfaced so far in the discussion, but a critical difference between ISSB and both GRI and ESRS is impact materiality, or double materiality. Not the same thing, of course, but so, if reporting on intangibles or understanding intangibles is not just an issue of reporting on value creation for investors. It's an issue of reporting to other stakeholders and how other stakeholders are affected by, pick a topic. It's not hard to think of issues where the interests of society at large are different from the potential for value creation in the context of intangibles. And that difference is absolutely fundamental to the reason why ESRS is a double materiality standard and why that matters. It's fundamental to why GRI is different from ISSB and why the two are not the same. And it's also critical to understanding the overlap between those different regimes. So, in conclusion, two thoughts. Firstly, unambiguously, we need to focus on value creation relating to intangibles, and that's a space which it's unclear whether that's IASB, ISSB, ESRS, GRI, or in some combination, but it's not just financial accounting. I think we've moved beyond thinking it's just financial accounting. And the second issue is we need to more be clearer about what double materiality means in this context. And so what it means to report on impact on other stakeholders in a way that's different from just reporting value creation to investors.
Thank you very much, Richard. Also very clear and opening the way to some reflections that go beyond necessarily the silos of financial reporting. It's not only about financial reporting, it's of course something about corporate reporting, and in this respect not only shareholders but is of course also stakeholders if we adopt a value creation view that is larger than financial value creation. Dear Eelco, so many times you've been quoted and GRI has always been pushed or just, attracted in these conversations. So, and also I must say that also the friendship we have, the fact that when I talked to you about this conference many months ago, you've been the first one saying, I want to be there. And I look at you, why? Which is a stupid question on my side, of course. But because I think, intangibles, in my previous perception, it was much more about financial value creation in a narrower sense. But now, if we enlarge, as Richard said, GRIs clearly must be part of this new vision. So, Eelco, why you here, basically?
Well, sorry if my voice is a bit cracky.
I know.
It's a bit of a cold. But I cannot agree more with Richard than I can. There is a big field that we need to dig into. And I would like to address it with two examples to see why there is still a lot to do and still a lot of research to do on where it fits in and how it should fit in, and perhaps that the trying to box it into a type of materiality, we have now like 6, that is taking away, I think, the essence of the discussion. It's more the result where we should get to. So I was for 2 weeks in India. And I had a couple of sessions with the Institute of Cost and Management Accountants India. And to me, it was new that there was this distinction between cost and management accountants and financial accountants, statutory accountants. And that apparently SEBI, the regulator, asked this Cost and Management Accounting Institute to draft a roadmap for businesses in order to be able to start to report on sustainability and sustainability-related topics. Well, the first thing that was interesting to me was that this body was asked to take the lead, and that apparently there is a distinction between the two, whereas, by the way, signing off, the right to sign off on annual accounts is only with the financial auditors. But the approach they were taken was basically to start drafting a maturity model for sustainability reporting, starting with the famous 1, 2, 3, 4, 5 levels. 1, 2, 3, 4, 5 levels, low maturity, reasonable, and ending with excellent, and then various topics. And the way how they want to build this maturity model is based on the GRI process and GRI standards. And to me, this approach was quite new. And I was asking myself, does that mean, if they go that approach, that, and we can think about it, is there a difference for accountants to become a financial accountant or to become an accountant on sustainability if there is not a direct monetizable value, recognizable, to assess the quality of the report, etc., etc., etc.? I don't have the answer. But to me it was like, I never thought about this one. And India is a big country. The other one is about a real example where you see intangible and monetizable linked closely together, and it's one of my old loves. It's about taxation. So there was a session, and I can't disclose the name of the business, where there was a question whether or not to use GRI 207 tax, the tax reporting standard. And that standard consists of 4 topics. The first one is strategy. The second one is the risk management and control framework. The third one is advocacy, which is a polite word for lobbying. And the last one is country-by-country reporting. And then there is a B, whether or not assurance or not. And the organization did a materiality test with the CFO and with the head of tax, and they came to the conclusion, we will not use GRI 207. Why? Because it's not material. Looking at the balance sheet and the P&L and the potential risks, it's not material. Then in the audit committee, the external auditor said, that's interesting that you say this. Because looking at your business model, 80% of your revenues comes directly or indirectly out of taxpayers' money. They're in healthcare, taxpayers' money. So if your tax behavior would be deemed not to be acceptable in some countries or jurisdictions, that could have a severe negative impact on your reputation and your future cash flows. So we think it is material to you, but not directly financial monetizable. So we take an additional amortization, or we deem dividend as interest and blah, 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 and double dipping, triple dipping, all that kind of stuff. No, it was on the very fundamentals, what is material to your organization or not. And that is where I think the whole debate on the various materialities and intangible, tangible gets a bit blurred. There is a moment in time that it always flips over into something monetizable. And I know we joined the same club to see if you can monetize certain intangibles in a specific methodology, which is not easy. Some people say you should not do that, because if we speak about social capital, should you be able to put an amount on child labor, human rights, indigenous people, diversity, equal pay, etc., etc., etc. Personally, I do not have a problem with that. If it contributes to the good and businesses understanding why they can or should take care on behalf of their investors and society, then I'm perfectly fine with it. But I think it is very difficult to exactly indicate what the tipping point is between intangible, tangible, between material, not material. And my guess going forward is that somewhere in perhaps the nearer future than we think, they will converge. And I would think that in due course, and what we now call double materiality will become something that will be seen more as materiality as such, since most of it is a timing difference. In the end, it will always hit your bottom line. The famous saying, you cannot run a profitable business in a dysfunctional society. And that's a good reminder for me to stop.
Thank you. Everything is organized, of course. Thank you for this, Eelco. Also to remind us that intangibles are part of impacts, and if possibly the monetization of impacts, and the fact that the world is also big. You remind us of India case, which echoes what Andreas said before. Stakeholders from around the world has not necessarily the same views. But, you know, how do you see, Patrick, you're there, because can we see Patrick de Cambourg? Oh, yes, Patrick, thank you. You were disappeared and I was getting anxious without you, of course. And so, can I ask you, we still have a few minutes, maybe we can take also some questions from the floor. What you see the way forward? If you went, I don't know, I posed similar question before, so sorry. The short term, probably you already told us, you know, that, you know, there's a plan to work on that. EFRAG possibly has to develop some guidance or some ideas. So, but in the medium term, how do you see the big picture? Patrick, and of course Richard, and of course Eelco. Please, Patrick.
If I may, first I would like to maybe chip in on the question of materiality. I see it as recently I had a long conversation with Richard on this topic. You know, after dinner, so it was, we had plenty of time. So, and I also had conversations with Eelco on this. You know, I am careful, I have 2 points. The first one is that I am careful about the controversy, the possible controversy between double and single materiality. I think it's highly overstated. And I think that there are, I have a feeling that if we want to make a distinction, we have to work conceptually on what are the impacts that have no financial effects, or that will not have financial effects. Are you still with me?
Yes, yes, absolutely.
Oh, okay.
It's a religious silence. It's something like religious silence.
No. And the ones and the impacts that have and the impacts that haven't. Because this is a very personal observation. I find it difficult. And on the other hand, I'm talking about material impacts. I'm not talking about any nitty-gritty impact that, of course, we have in business. So I am very careful about that. And I have, of course, a feeling that if an impact is material, has no financial consequences, then if it was the case, why the hell is it still a material impact? In other words, if you can solve it, remedy at no cost, why don't you do it? So this is fuel for thought, because I think that we need to drill down further. I see also on the investor side a significant development. Sometimes it's a bit bumpy, but I see a significant development of impact investing. So, okay. The other remark which I wanted to make is that I see, I'm careful about monetizing everything, because I think that it depends. If you do it under a dynamic materiality approach, why not? If you want to do it under a static system, first of all, there are a number of elements that are very difficult to monetize, or it would be based on conventions, and that, you know, unless you have global conventions or even EU conventions, for instance, then the comparability is going to be difficult. So I'm careful about that, because I see also under the dynamic materiality a number of channels through which, either a risk or an impact may translate into financial effects. It can be, stopping certain activities and therefore reducing your turnover. It can be, on the contrary, an opportunity to develop turnover. It can be additional costs. It can be investments. It can be restrictions in your access to capital. So there are many, many different ways, and monetization, simply said, is a bit too generic. Medium term, I am convinced that, one, we would have to have a good look at sustainability reporting and the connection between sustainability reporting and intangibles. To have a look where, through sustainability reporting, we gain additional knowledge of intangible development regarding the value creation, and then see what are the areas that are still to be considered in the future. For me, I am calling for a phase of analysis, because it's already a big step in the EU to move to sustainability reporting as defined. There are elements of intangible value creation that are embedded indirectly into this, and that is somehow recognized in the CSRD. Not as much as we would want, but because it's not easy, and we understand that it was a step forward. So analyzing this and then trying to see what are the possibilities to improve under some sort of integrated reporting approach, management commentary, you call it the way you want. I think it's where the progress could take place.
Thank you, Patrick. For Richard, do you have a dream?
Do I have a dream? So this issue of impacts being financially material, I think, is hugely important and requires a lot more thought. So at one level, the argument that if a business has a significant impact, that information must be material to its investors is very beguiling. You know, it kind of it makes sense at some fundamental level. At the same time, if business has an interest in, as it were, internalizing externalities or operating in a way that's in alignment with societal interests more broadly, then we wouldn't be about to exceed 1.5 degrees of global warming, and we wouldn't have the level of natural resource depletion that we have, and so on. So it's self-evidently not the case that economic activity has gone hand in hand with the interests of future generations, as it were. So there's a disconnect there somewhere. If you take an intangibles example, artificial intelligence was mentioned earlier. I'm no expert, to be clear, on AI, but you know, it's not difficult to picture a business in the AI space finding opportunity for private economic gain in that industry because the opportunities are huge, and for that to be in the interests of investors in the AI company. At the same time, people who know far more about this industry than I do are advising governments that the industry should be shut down because of the social threats that it poses, right? So there's clearly a conflict, and so how you think about that, how you resolve it, I don't know. But it seems to me, I find myself more a supporter of double materiality than most supporters of double materiality, actually, as it were, because I think you absolutely need sustainability reporting for investors to make investment decisions. But I think you absolutely cannot assume that investment decisions in and of themselves will address all of the social, as it were, needs and expectations that we have from corporations.
Thank you, Richard. Interesting. Eelco.
Well, we are going to quote you on that, by the way. If you look at brand and brand value, that's tremendous. So I had a discussion with my wife on handbags. So if you look at Hermes or Kors or whatever, if you look at the cost of the materials and how and where it was made, then you would not come easily at 15, 16, 25,000 euros or even more.
Yeah.
So apparently there is a value on the name, whether it is out of snobism or whatever, but it has a big value. If I were to be investor, I would always invest in those organizations with a very strong brand name, and they are not always reflected in the share. They're more reflected in the share price than that you see them on the back of a balance sheet. Why do I say this? Because topics like handbags, what we see developing, we see also more and more on the more social topics. We discuss social capital, but also on governance. And I think they fall more or less within the same scope.
Thank you. Thank you, Eelco. Any questions from the floor? We still have about 5 minutes. Mario? Yes? A blue-collar professor here.
Yeah, exactly. Thanks, Stefano, and thank you both. Excellent presentations, and Patrick as well. I wonder whether we've got a bit too obsessed with this bright line between, single and double and financial, not financial. I mean, as an investor, whether an impact has a probability greater than 0 of converting into some kind of financial risk or some cash flow for the business, isn't it important in terms of accounting serving its accountability function to actually tell investors about that stuff? Like, isn't it critically important? So is it really for us as accountants to be the judge to say, hey, you don't need to know about the fact that Stefano is an alcoholic and, that he's going to completely destroy this business. That's an externality. Don't have to worry about that. But, have we kind of lost sight of the importance of accountability? And we have this quaint notion, and I know it's a very British thing, but, to present fairly, the true and fair view. Isn't there a requirement on accountants really to convey the true story of what's really happening? And that's showing the whole picture, not just the nice side of the picture that I want to show. So
I was studying warning a bit about this question. Who's going to take this up? Richard?
I think, Mario, the issue is accountability to whom, right? So for ISSB reporting, if it is important for investors to understand that Stefano is a reformed alcoholic, or whatever it is, right? This is casting a horrible side. I mean, maybe we should drop the example because it's not true. But then so impact of the business, of course, is maybe provide material information to investors. So S2 requires Scope 3 carbon emissions, which are impact data because it's clearly relevant to investors. That's not the same thing as accountability to an audience that's not investors. And so if you think more broadly about the role of the corporate sector in the economy, there's a question about whether serving investors' interests alone serves the sustainability development goals of society. Right? So I think that's.
Can I chip in?
Yes, Patrick, and after, of course, Eelco.
No, I just wanted to it's very, first of all, congratulations, if you become an alcoholic or if you are, you might be even
like to
funnier.
be known for that. After 30 years of experience and career, it's like that.
No, okay. No, more seriously, the ESRS approach is, you start, but you are not limited to, of course, material impacts. And disclosing material impacts is step one. But then you explain, as a business, your vision of the translation of those impacts into short, medium, or long-term financial effects. So you have full transparency. And you explain also your understanding, your perception of the potential translation into financial effects or not. And I think that, that is, this is a discussion I had with Richard, and I hope you don't mind, Richard, if I disclose that, we have to be careful, in my view, but this is probably a topic that we could discuss further or debate further. I'm careful about the average investor because, I see a full spectrum of investors that go from the ones that are only interested in short-term value creation and even maybe, market fluctuations. I see, and it goes to the other end of the spectrum, that people that are, interested by impacts. I remember vividly a discussion that I had at the Eurofi meeting in Santiago with the leader of one of the stock exchange supervisory authorities and an important person in IOSCO, when I was trying to explain that impacts, it was difficult to say when an impact was translating into financial effects or not, he said, "Oh, don't worry, Patrick. Impacts per se are interesting many investors." So that's where we have to get our act together jointly, I mean, in a spirit of commonality between GRI, SSB, EFRAG, on how that can be addressed from a conceptual standpoint. Thank you.
Thank you, Patrick. We're going to finish with Eelco.
Well, first of all, I will go short in my share, Stefano. I think the risk is too high. The very simple remark, it all starts with the boardroom and the integrity of the information they are willing to provide voluntarily. That's for sure. And then, of course, it needs to be digested and produced in a format that we call standard. But first of all, I think it is in the boardroom that they must also decide what they want to disclose, how they want to disclose it, and why they think it is important for investors and others before even we go into the details of the various materiality concepts.
Thank you for the debate. Is of course a big one. One word of closing. First of all, let's thank all of us, these fantastic speakers. Thank you very much, Patrick, Richard, and Eelco. Of course, the debate is going to be, quite acute and important in the next few months, I suspect. A lesson learned for me, just to close, and saying it's incredible how many organizations and distinguished people talk about intangible from different perspectives. That's what I learned. Andreas is right. We need maybe some convergence. That's why this morning, maybe you weren't there this morning, Mario Bella launched the idea of international study group that doesn't commit anybody, but would permit us to experiment, as you said, Richard. Because of course, this cannot be only one body problem. Clearly is something much larger, so we will try to set up, an international study group where we can be freely say what we would like to say, and the vision and so on, because I think it's incredible. 2015 in Paris, Andreas was there, many of you were there, and now again to 2023. So sometimes, this déjà vu type of story, I think we need to, to contribute, and of course we would like to convene as WICI, an international study group, just to have the freedom to act freely, and so it's always the WICI fault anyway. So that will be the idea. So thank you for this. Have a nice lunch, and we start again at 2 o'clock with those that have done something. Okay, those that have done something. Thank you very much.